Hello, everybody here. My name is Casey Seaborn from Stride, and I'm here today with Morgan Holmes, who's going to be educating on our topic for the first ever Stride Live, optimizing your MSP's business entity structure for maximizing tax benefits. So I'm excited to introduce Morgan Holmes today. How you doing today, Morgan?
Doing great. Thank you, Casey.
Awesome. So, a couple of the things we're excited to cover today is essentially how business owners can really set the structure of their entity to achieve their goals of the business and of the owner. And if there's more than one owner involved in the business, what is the most advantageous structure to make sure the compensation is the most equitable agreement possible based on the roles within the business? So, Morgan, I'd love to hear a little bit more. How does a business determine how they structure their entity for maximizing their business?
Yeah, great. Thank you again, Casey. Yeah, typically out of the gate, a business owner or owners will uh, typically operate as Schedule C or sole proprietorship, which actually isn't the most tax efficient structure for a business owner to be operating in. And so, what we typically do when we have clients that are Schedule C operators or operating a business as sole proprietors is we'll work with those owners to figure out what is the most tax efficient structure. And sometimes tax isn't the driver on the structure at all. So, for example, you might have two owners who one is putting in money, the other is not. And before the other owner gets anything out of that business, the owner or the shareholder that contributed the cash or partner that contributed the cash or capital would get his or her equity back before the other shareholder. And in that case, certain types of businesses or certain types of structures aren't appropriate. So, for example, most small to mid-sized businesses that we see are typically S corporations.
Mm-hmm.
And S corporations have fairly rigid requirements around allocations of profits and losses, distributions coming out of them. So, in a situation where you might have kind of non-pro rata distributions or allocations of income, the S corp is not an appropriate business entity structure. But again, most businesses that we see are S corporations because of the tax advantages that you typically will see in an S corporation. So,
Absolutely. And for the MSP owners out there, when say the partnership model of, hey, I have two partners, I'm running operations and I'm running growth of the business, what would be the advising for, say, a 50-50 split for those MSP owners?
so you mean if they want to split profits 50-50?
Correct. Yeah. Ownership, profits. Hey, we're going in this together, everything split down the middle. What's the most benefit for them or structure of entity should they choose?
Yeah, typically the most appropriate structure in a business entity like that or a business like that is the S corporation. So, with the S corporation, it allows you to pay yourself a reasonable amount of compensation. So the shareholder owners will receive W-2s from that business, and so we would look at what's a reasonable amount of compensation, and then we would recommend that the owners then take distributions beyond that as a way to pay themselves or extract some money out of the business.
And in terms of when it looks to splitting profits, what are some of the cases you've seen that are unique advantages? For instance, a business owner experiences an increase of profit. It's October, November of that business year. What are some of the strategies they could have using an S Corp entity to make a sound decision so that doesn't just go to taxes or extra profit?
Yeah. So again, early in the year, we look at reasonable compensation, or even late in the year prior, we would look at what's the reasonable compensation structure for a business owner.
Mm-hmm.
They pay themselves that salary and take the rest through distributions. If they end up in a situation where they have, large amounts of income beyond what they were expecting, we might look at things like paying profit sharing distributions or profit sharing distributions to 401k plans, so that the owners can then extract some cash and the business would then get a deduction for that, rather than just taking that cash out and putting it into a taxable account. We might recommend taking that extra cash and again putting it into a 401k.
Makes sense. So it sounds like that when choosing the right entity for your business or tax entity, it really is less of the priority is on what the tax liability is, and it's really more on cash flow. Does that sound about right? Do I understand that correctly?
Yeah, a little bit of both. I mean, we focus on what the tax advantages are, what tax advantages can we get out of that business, but also cash flow, right? If you don't have the cash to make large contributions or profit sharing contributions to a 401k, then obviously that's not an option. Maybe they have a little bit and can make smaller contributions to a 401k profit sharing. But yeah, cash flow is always king in a business.
Now, when talking with the entity, how difficult is it? Let's say, hey, I started a business with my owner. We just did a regular partnership. How difficult, or what are some of the considerations if I want to make that decision to elect to be an S corp? What does that process look like?
Yeah, so if it's just a Schedule C business, where the two guys or two people have come together to do business, you would either need to set up an LLC or a corporation, and then elect to be taxed as an S corporation. If it's already an LLC, then the process of electing S corp status is fairly simple, but would need to be done at the beginning of the tax. The requirement is that you have to make your S election within 75 days of the beginning of the year. So if you already have a business entity that is not an S corporation and you would like to become an S corporation, then the election needs to be made at the beginning of the taxable year. But it's a very simple process.
Got it. And then when evaluating the different types of entities, what are some of the individual, let's say a business owner considerations? For instance, their spouse, maybe other sources of income. Is there any other considerations they should have when thinking outside of just the business that they're owning?
Yeah, typically the first thing we think about is what is the business arrangement. If it's a multi-person entity, so more than one partner or shareholder, we would look at what the business arrangement between the two or more members is. So that's sort of the first step, because or even S corporations have limitations on who can be an S corp shareholder. So non-US persons cannot be S corp shareholders, and so if your business partner is a non-US person, S corp is not an appropriate entity structure. Yeah, so I mean, typically we'll look at the business arrangement amongst the members or potential shareholders of the S corp is the first step.
Got it. And in terms of electing to being an S corp, because it seems that many MSPs and many of the smaller businesses, when would they decide that, hey, maybe an S corp is not the right decision for them? What are some of those cases where sole proprietorship or partnership or even C corp might make more logistic or financial sense for them?
Yeah, so typically we would look at something like that as a business is getting started. Help the business determine the correct structure of the business entity. If they already have an existing structure, we might start looking at that in the late fall, kind of November, December timeframe, to make a determination. Hey, if you are going to choose to be an S corporation, and you simply wanted to use the business structure you were in and make an S election, we would want to kind of flesh that out before the beginning of the year, so that everybody knows going into the new year, that's an election we want to make.
Got it. Got it. And what are some of the tax conversations around tax strategy and planning, for instance, setting the structure of the entity to really allowing them to maximize their compensation? Hey, I'm a business owner and I have free profit, but I need to pay myself a salary, but I also want to maximize how much I make as a business owner, if possible. What are some of the considerations with that?
Yeah, so again, reasonable compensation is an important element to this, because you need to pay yourself a reasonable salary, and beyond that, we would take distributions out of the business. But
Mhm.
before we actually take some of those distributions, we might look at things like retirement plans, fringe benefits, et cetera, that a business owner can extract out of business to increase their compensation out of that business.
Gotcha. Now, we've talked a little bit around the formation. So when starting the business or you're already running early stages, how do we match exit planning? Because eventually business owners retire or they sell or they grow and scale and bring on partners. What are some of the structure alignment questions that you should ask when you're saying, I want to sell this or I have 10 years in this business? What are those considerations aligning that with their exit strategy?
Yeah, so when you sell a business, you're typically either selling assets of the business, or in the case of a corporation or an S corporation, you're selling stock. And so selling stock is the most advantageous because it gives you capital gain treatment on the sale of the stock. With an S corporation, when you sell the business, you have the option of selling the stock or the assets of the business, depending upon how you structure the sale. And so when you sell assets of a business, the tax implications could be a little bit higher to the seller. So generally speaking, we would want to try and sell the stock of a business. Buyers typically want to buy assets. Sellers want to sell stock, and so just trying to find or negotiate that deal when it comes to the time of sale. But stock sales are definitely more tax advantageous for the seller.
Now, going through that process, let's say I'm an MSP, I own a $3 million MSP, my EBITDA is around 20%. What are some of the considerations I should be looking at to maximize that exit value when it comes to selling the business, whether I sell stock or assets? What are some things that I can do in the daily process to make sure my financials can undergo that level of scrutiny during that transition process?
Yeah, so I mean, typically, like I said, sellers are going to want to sell stock and buyers are going to want to buy assets, right? So sometimes it just doesn't make a difference. So, for example, if you have a business that has very few assets, very few fixed assets that you've taken depreciation on, or other assets like receivables or anything like that, you're simply just selling a client list. Then it doesn't really matter too much whether you sell the stock or the assets of the business. So before we go into an exit of a business, we would want to look at the balance sheet, figure out what our basis and assets are, if there's any assets there, so that we can start kind of laying the groundwork of what are the potential tax implications of one way or the other.
Got it. Now, for those newer entrepreneurs, the newer MSP or professional service agency builders who are saying, I want to start this business as easy as possible, but keep the opportunity to bring a business partner in down the line without making it an arduous, expensive process. What would be the advising on that?
So, so obviously S corps have their limitations, right? So if you're going to bring on a business partner that may or may not be, or maybe a foreign person, that S corp structure isn't a great structure, but still you could sell the stock, or, bring on an investor that's a non-US person. You would just terminate your S status. But typically what you'll see, and maybe not so much in the MSP or professional services space, but like in the venture capital space, you're going to see investors want to invest in C corporations, not so much pass-through entities. So I think kind of out of the gate, if you wanted to keep it simple, and if your business isn't too large, then you might want to consider setting up a single member LLC or a multi-member LLC as the business structure, and then evaluate making the S election down the road.
Absolutely. That makes sense. And in terms of you starting the new business, I want to provide that value for any listeners and the listeners today. You started it, you've chosen an S corp. What's kind of that next step? Is it, do I build my chart of accounts? Is it, do I look for the processes from an accounting, financial, and compliance management standpoint? What is that next stage? I have my LLC, I build my S corp status. What's that next step?
Yeah, so I mean, obviously the next step is getting your accounting environment set up, right? So choosing your accounting platform, your bill pay platform, your billing and receivable platform, because all of those functions are necessary to actually prepare a tax return down the road, right? We need a pretty clean set of books. If you're an S corporation, we would be including a balance sheet and an income statement in that tax return. So having a good set of books is important, and setting up that accounting environment is your first step.
Setting up the foundation before you have to have tax time, so we're not scrambling later. It makes sense. It makes sense. But so many people, I feel like they get stuck. They find that, oh, I got the paperwork, all the legal, I'm ready to go, and they start running their business. If you take that extra 10 minutes, that extra 20 minutes to really take the time, look at the right accounting, find a professional who can set up a good foundation, sounds like it really opens you up as a business owner to take advantage of whatever tax and compensation benefits are available to you. But the reactionary, I know I've heard you say before, you're talking to your CPA in January of the tax year or of the prior tax year, you're already too late. If it's 2024 January and you want to talk about 2023, it's already too late. So I think that's one of my big takeaways. When it comes to tax, proactive and early as possible. The earlier that you reach out to a Morgan or a professional who can help you, the earliest they can provide all of the options to you and give you the opportunity as a business owner to make really the best decision for your business instead of just having to react and choose an option because it's the only option left.
Yeah, yeah. I mean, if we think back to the COVID time, right? When COVID was just starting and the government was starting to push out all these COVID benefits, if you didn't have a good set of books early on, you were going to be late to that game, right? I mean, right when the PPP loans first started coming out, you needed to have a pretty good set of books to apply for your PPP loan, and those that didn't kind of missed the boat on the first PPP loans. So ultimately, they ended up getting them because they expanded the PPP program. But those that had good accounting records and good set of books were obviously the first to apply for those PPP loans and got them.
Absolutely. And that was a lifeline for many business owners during that period. So it just shows it's
yeah. Well, I guess my point there is you never know what's going to pop up, right? If you were 12 months behind on your bookkeeping and something like the PPP loan came up, you were going to miss the boat.
And how often do you find situations where business owners don't have a true handle on the bookkeeping or the accounting, and it causes you to be less of an advisor and more of truly a bookkeeper or a data entry or a classifier? How often do you see that?
I see it fairly often where small businesses don't really keep up to date on their books and records, or don't really appreciate the effort that should go into that, and it just makes the tax preparation process that much more difficult. And
Absolutely.
even before you get to the tax preparation, the tax planning is virtually impossible if we can't see a good clean set of books.
Absolutely. And when we talk about entity, let's say I'm an individual business owner and I want to say, hey, Morgan, how do I use my business to reduce my overall tax liability, both from a business side, a personal tax side? Maybe I own a few rental properties or a couple of side ventures. How does one look and say, and take that full circle and say, what is the plan? How do you build a plan for that? Is it taking considerations from the entity? Is it just grabbing that full picture, making sure the data? Where do you typically start in that process?
Yeah, so the process is all encompassing, right? You have to look at the business and the individual as one, right? So anything that you do in the business entity is going to affect the individual's tax return, right? So if you're taking a lot of compensation beyond what is reasonable, you could be limiting your ability to take things like the qualified business income deduction, or many states have pass-through entity tax credit. So if you're compensating yourself a lot, you're driving your income down, and when you're driving your income down, you're driving things like again, the QBID, the qualified business income deduction, or those pass through.
Stop me for a second. What is that? I don't know. I've never heard of that. What is the qualified business deduction?
Oh,
What
sure.
is that?
It's the 20% deduction that came about in the Tax Cuts and Jobs Act that was passed in 2017. 17. So it's 2018 through 2025. There's a 20% deduction for your qualified business income.
Wow. Wow. I think a lot of our followers do not know that. That is, I did not know that. And
Yeah.
shamefully, as an accounting background, I did not know that. So
Yeah. So if you
that's
wipe out your income by taking too much compensation, you might also be eliminating that deduction entirely.
got it. Now, Morgan, for the viewers who might have said, you know what, I don't have time to watch a webinar. It takes a little too long. What's the 60-second most valuable piece of information that they could take and is actionable for their business today?
Yeah, I mean, take a look at your business structure. If you're a Schedule C, you almost assuredly are overpaying taxes, and start to engage with an accounting and tax professional to look and make sure that you have the most optimal and tax efficient tax structure for your business.
Awesome. So taking a look at the foundation first. So for the listeners out there, for those viewing this after the fact, take a look at your business entity. What's the structure? Understand your goals. And then if you're not sure if it is the right entity, reach out to a professional who can take a look and provide you some sort of guidance. Because that matching of goals and that whole accounting wholeness and wellness, that holistic approach, it starts with the financial data foundation for the people like Morgan are truly effective. So, Morgan, I want to thank you again. Thank you for taking the time out of your busy day to jump on the webinar here. And if you guys have any questions, comments, or would like to reach out and be a guest, you can reach out to me at casey.seaborn@stride.services or on LinkedIn directly in the video. Thank you so much, Morgan.
All right, thank you, Casey.
Bye.
Bye.